We have the quarterly refunding announcements this week. We've already seen that the first quarter of this year was record borrowing by the Treasury. Are you concerned that we're now looking at a lot of factors putting the Treasury market in a very different place this year from last year?
No, I think the good news is the U.S. Treasury market is the most liquid and robust market in the world. And while I won't comment on interest rates because I respect the independence of the Fed, what I will say is the market, the forward curve, expects interest rates to go up. How much it goes up and how fast it goes up, we'll see whether it's more or less than the market predicts. But part of the reason why we see interest rates going up is because we've created economic growth. That's a good thing. So we've been focused on targeting 3% sustained GDP. And part of the reason why interest rates have backed up is because of that economic growth.
But Bob Michael, the head of fixed income for JP Morgan Asset Management, he said on Bloomberg this morning he'd never seen as bad demand and supply conditions in the Treasury market, with so much supply coming on, and also central banks, the Federal Reserve, others running down their balance sheets. So many things coming together.
Well, let's just say again, it's a very large, robust market. It's the most liquid market in the world. And there is a lot of supply, but I think the market can easily handle it.
I think just when we think about what are the potential bumps on the road that you could have in terms of the global economy or markets, there's always been a lot of concern about how this more normal monetary policy was going to play out in the long-term yields. You see yields going to 3%. We saw markets responding to that. For you, is there a danger level that you think of? It's not 3, but is it 4? What would worry you in terms of really causing a pressure in the financial markets?
Well, let me just say I have tremendous confidence in Chairman Powell and his leadership at the Fed. And again, lots of these issues are interrelated. It depends on where inflation is. It depends on where growth is. It depends on where unemployment is. There's lots of issues that are all interrelated, I'm sure, as they look at monetary policy.
But the factors that are coming into it is that you have maybe reduced demand and a big increase in supply. That's quite basic, and that's actually independent of the Fed policy. We're not just commenting on the Fed policy. We're talking about the amount of supply that's going to be washing
well,
into it.
By definition, supply and demand will equate.
Well, it could be at a very, very high rate in terms of yield.
I'm not concerned about that. I think there are still a lot of buyers for U.S. Treasuries.